Hello, I'm Dr. Cheryl Dunn, and I'm here to demonstrate an intermediate financial accounting problem for a fictitious company called Wolvelakers, Inc. Wolvelakers, Inc. provides consulting services, and some of their customer contracts involve variable consideration. In other words, it's not clear how much Wolverine will end up making from the contract because it depends on some outcomes of that contract. So we're going to look at a problem like that and see how we would calculate the revenue that Wolvelakers should recognize over the life of the contract. So take a look at the problem. Pause the video for as long as you need to read it. Okay, so the first method that we're asked to use is the expected value method. And under this method, we're basically going to take the possible amounts that Wolvelakers could be earning over the life of the contract, and we're going to multiply by the probability that that amount is what's going to be. Then we add those calculated amounts together to get the expected value of that revenue contract. So the first possible amount that Wolvelakers could end up getting is just the contracted $24,000, the guaranteed amount. And they said that there's a 20% chance of that happening, so we multiply that by 0.20, and that gives us $4,800. We then take the next possible amount, and the next possible amount would be the $24,000 guaranteed plus the $10,000 bonus that they said there's a 60% chance of them getting. So if we add those together, we get $34,000 as the possible amount, and again multiply by a 60% chance of that happening, and that comes out to $20,400. Finally, we take the other possible outcome that we're given, and that is that they would end up getting a bonus of $25,000 on top of the $24,000, and that would give them a total of $49,000. And they said that there is a 20% chance of that happening. 49,000 times 20% is $9,800. And now if we add these three amounts together, that's going to give us $35,000 as the expected value that the company will earn over the life of this contract. Now this contract is for 6 months, and that means that we're not going to recognize all $35,000 in the first month, but rather we're going to divide that by 6 months, and that would give us $5,833 per month. Okay. If we were going to make journal entries, the problem didn't ask us to do this, but if we were going to make journal entries to record the events associated with this contract, on May 1st, what we would do is we would debit cash for the $24,000 that they paid up front, and we would credit deferred revenue, which is a liability for that $24,000 since we still owe them the services. Then on May 31st, at the end of the first month, this is the one that's more interesting, we would then record this $5,833 as earned revenue, but notice that we're not going to take that all away from the deferred revenue. Rather, we're only going to take 1 month worth away from the deferred revenue. So since we put in 6 months at $4,000 a month, we're going to take away $4,000 from that, indicating that we still owe them 5 months worth of services. Then we're going to recognize a bonus receivable and service revenue. The service revenue is going to be for that full amount, the $5,833, and that means we're going to debit the bonus receivable for the difference of $1,833. If they ended up receiving the $10,000 bonus on December 15th, then they would debit the cash for the $10,000, and they would credit the bonus receivable. Now notice that what's going to happen after 6 months of this contract, the bonus receivable has been debited for $1,833 each month. If we multiply that $1,833 times 6 months, that gives us $10,998. So we would have recorded that amount as the total bonus receivable over the 6 months. So now we have to credit it for that full amount to indicate that they don't owe us any more. The question is, what do we do with that $998 difference? And the answer is, because we had recorded a little bit more revenue over the life of that contract than we actually earned, we now have to debit that service revenue for that difference of $998. It's not quite the full 1,000 because of the rounding error in rounding these numbers to the nearest dollar. When we recorded the revenue, we didn't actually record all 35,000. We only recorded 34,998. What if instead they received the big bonus? What if they received the $25,000 bonus? Then on December 15th, we would debit the cash for $25,000. We would still credit the bonus receivable for the amount that we had originally put into it, because they don't owe us that anymore. And then we would credit service revenue for the difference, which in this case would be $14,002. What if on December 15th we found out that we weren't getting any bonus because the performance did not increase enough? Then what would happen on December 15th is we would have no cash to debit. We would simply debit service revenue for the $10,998, and we would credit the bonus receivable also for that amount. Because in that case, we would have recorded nearly $35,000 in revenue over the life of the contract, when in fact we would have only earned the $24,000 guaranteed amount. And so we have to back that back out of, forgot the V there, service revenue. All right, now the second thing that the problem asked us to do, this was the expected value method. They asked us then to calculate the amount that we would recognize as revenue under the most likely amount method. Under the most likely amount method, we simply take the guaranteed amount of $24,000 plus the most likely bonus, which was the $10,000 bonus, and that would give us $34,000 as the amount we're most likely to earn over time. And again, we need to divide that by 6 months to get the monthly revenue to recognize, and that would give us $5,667. The journal entries would look very similar to what we saw over here. We would receive the cash up front just like we saw here. The revenue amount, we would still have the deferred revenue being debited for $4,000. We would be recording the service revenue of $5,667 and the bonus receivable for the difference. Then on December 15th, we would have made a similar entry to one of these three, depending on which kind of bonus we got or whether we didn't get any bonus at all. So that concludes this demonstration. Thank you for viewing, and have a wonderful day.